Well, welcome to Just Think About It with Nadine and Ben. We're recording this episode on Tuesday, December 17th, 2024. Before we start our conversation, we have two key requests. First, if you're enjoying our podcast, please subscribe via Apple, Spotify, X, YouTube, or your platform of choice, and make sure to hit the like button. Second, we appreciate any kind notes and feedback and would appreciate you letting your friends know where to find us. Today, we're thrilled to introduce you to Brad Lundy, the founder and CEO of Butler Hall Capital, a fundamental equity-oriented asset management firm that has a flagship long-short equity product as well as a long-only vehicle. Prior to founding Butler Hall, Brad was a partner and portfolio manager at Ivory Capital, a multi-billion-dollar AUM value-oriented equity long-short hedge fund based out of LA. He began his career working in the trading pits at the CBOT, CBOE, and Third Millennium Trading in Chicago. So, Chicago guy, we have a lot to talk about, and I need to know if you like Chicago dogs. So we'll come back to that. But welcome, Brad.
Thanks for having me. Do like Chicago dogs.
Okay, good. Very important. Very, very important. So, Brad, before we get into specific opportunities that you're seeing, I'd love to delve into your investment philosophy and the strategy that you pursue at Butler Hall. What is it in summary so people get a sense of it before we go into, some of the individual investment opportunities that you're seeing?
Yeah, of course. So we employ a fundamental bottoms-up investment philosophy in the public markets. So private equity approach to the public markets. We generally have a 3 to 5 year investment horizon, and we tend to allocate our time and capital to industries that are undergoing change. And I'll probably
Okay.
further define that in a little bit. From a bigger picture standpoint, I came out of a firm called Ivory Capital, and most people like referring to the tiger cubs and the growth oriented investors. I came from a lineage tree that was the kind of deep fundamental value group. So
Okay.
the founder of my prior firm came out of a firm called SC Fundamental or Siegler Collery. And most people who are not dinosaurs like myself probably have never heard of it, but it birthed a lot of larger value managers, from David Einhorn to Scott Ballmer to the founder of Ivory, Curtis McGuinn, et cetera. So we kind of come from that lineage, which, there's not many of us left, but the alpha generation opportunity is quite large.
So it's funny because I was at a shop that was very similar to SPO. Do you remember SPO?
Yeah, I do.
Partners out of the West Coast. So same kind of thing, the private equity approach to public markets. I was at Blum Capital, so probably have a sense of what you were doing. But maybe you could give our listeners an idea about your investment process. So you say kind of value bottoms up. What does that mean today in today's market, right? Because you look back 20, 30 years ago, if you read a K or Q differently, you had an edge or met with management team, and now it's a little bit different story. So, what do you look for in potential investments? What does your investment process look like?
It's interesting. You made the comment that 20 years ago you could find something in a Q or a K and it would be really truly valuable. We kind of went through a period where efficiency, I think, eroded that, right? And that was kind of the
Yeah.
emergence of long short equity from 2005 to call it 2015. But here we are 2 decades later, and I would actually argue you can dig through Qs and Ks and find gold nuggets of alpha. So in some respects, we've kind of gone full circle. From a broader perspective, we try to look at industries undergoing change. And by change, I don't mean, let's look at the new SaaS, right, oriented part of the
Okay.
market, but anytime you have a stagnant industry with no alterations or no real changes, the alpha generation opportunity is effectively little to none, right? It's very easy to forecast, easy to predict cash flows, et cetera. You insert, right, change, whether it's competitive or secular, right, fundamental, et cetera, all of a sudden there's an opportunity for mispricing. And sell side analysts and buy side analysts often can effectively misestimate, misanalyze, right,
Sure.
various industries and classes. So we kind of start from a top down perspective, and we look at a whole host of healthy industries that are undergoing change and effectively document that process internally to identify areas where we would want to deploy capital.
And is
And
that across sectors? So are you finding good industries in every sector, or do they tend to kind of hang out like nice friends tend to hang out with other nice friends? Are they in certain sectors that you're finding these industries or opportunities undergoing change?
I would say it is across sectors, but obviously there are certain sectors where there is perhaps less of an opportunity in one market cycle, and then
Uh-huh.
fast forward a decade, right, and
Okay.
it's certainly different. So, like, I'll give you a good example. If you were spending time in, I'll blanket brush it, but the industrial sector in 2000 to 2010, all it was really tied to was the emerging growth of China,
Mhm.
right, and then the coming collapse, right, in the 0809 recession. From 2010 to 2020, there wasn't really a lot that took place. And there were a couple secular themes, such as right, the aviation industry, but there wasn't really a huge amount of opportunity. You look at today, there's huge bipartisan infrastructure laws, there's EV vehicles,
Mhm.
there's data center builds. All of a sudden, there's a whole host of dramatic industry changes that create both tailwinds and headwinds in various subsectors. So, an area, right, let's take independent power producers, which were boring and cyclical a decade ago, today have really unique investment characteristics that wouldn't have existed in the prior cycle. So hopefully that kind of gives you a sense of how perhaps industries can change, and by identifying some of those currents or
Mhm.
winds, right, there's an ability to generate alpha.
And
And
when
and
you think about that,
go ahead.
go ahead, Nadine. That's fine.
Well, I just wanted to know, so your investment process, do you guys sit around and talk about these industries and say, okay, this is where it's fruitful to start looking, and then we want to talk about some of the winners or losers. So maybe dig a little bit deeper into that investment process and how you're uncovering that hidden treasure.
Yes, so we do from a top-down perspective try and identify industries that have, we'll say decent tailwinds or growth. My team will then force themselves to dig through the various players,
Hmm.
industry competitors, and effectively document what might be potential investments, whether it's today or down the road internally. And
Yes.
every name that we go through, we actually have an internal log called our discard log. And we document under what circumstances would things need to change that would actually determine a capital allocation decision. So if you think about that process, and I require my team to actually speak with one new company a week and actually document that. But
Okay.
as you build that up over the years, it allows you to fast track industries and potential
Yes.
investments when something changes, right?
Yeah.
And the speed to market to actually deploy capital when there is an event, right, or something that is unique is really important to have that process in place.
And
Is
the
there?
other question I'm going to bug you on, sorry, Ben, before I let him over to you to ask the questions, is that this is very similar to what I did for a long time. And one of the ways that I felt like, we had made a mistake in time was, you have, it's like, okay, you're going to be looking for whether it's regulation or change to capital allocation or certain things that are going to make that fundamental thesis work. But then there might be something macro going on. It could be changes in interest rates or something else. So
Mhm.
how do you think about the fact that you are a fundamental investor, but that there are other things that are moving a security price? It could be technicals like capital flows, or someone's trading that security for a reason other than fundamentals, and then there's macro elements too. So how do you guys does that ever factor in your investment process, or are you just looking at those fundamentals?
So I'd say it's mostly bottom up, fundamentally driven, but we do run a long short fund.
Uh-huh.
And if there are specific characteristics that we do not want to effectively underwrite directly, we will seek to hedge that out.
Okay.
Right? If you find the greatest airline in the world, we don't want to necessarily take the volatility of travel exposure. We may not want to take the volatility encompassed within diesel prices. So we may seek to hedge out or pair out a respective airline on the other side. But that's more to really isolate what we think is our strength, which is
Mm.
idiosyncratic, individual security selection.
Okay, thanks.
I mean, then you don't really worry about the correlations and the stationary or non-stationary covariance of the like. hey, I'm going to own a Mexican airport. I'm going to own Alibaba. I'm going to own, Vistra and IPP. I'm not really thinking about how these correlate within your book, or is it, a situation where you're just trying to manage the gross and net and some level of market beta, I guess.
Yeah, so we are not a market neutral, beta neutral, factor neutral platform. And while there is a real value for that in the marketplace, that is not what we seek to do. We don't employ the same type of leverage. Uh, Differently, we are factor aware. So what we want to make sure is we construct a portfolio that has the duration and the ability to see its investments through. And to the extent you're betting on XYZ company and it's 5 times cash flow, and that thesis is put at risk by a specific macro factor, yes, we will seek that out. If it's something that can create interim volatility as a result of a macro factor, we may just simply endure that volatility as well. So broadly speaking, we run a diversified portfolio from a sector perspective, from an exposure perspective, and moderate levels in net exposure. And that effectively enables the Encompass portfolio to withstand great levels of volatility, both on the long and short side.
And how many names are typically in a portfolio?
About 40 longs, about 30 shorts is a good reference point.
And do you move around the net and gross very much?
We generally tend not to. It ranges more or less between 40 and 50%, call it mid 40s on average.
All right. So okay, I got a serious question for you, right? You're a fundamental value discretionary stock picker. What is your favorite antidepressant? I feel like you should know, right? It's been a rough 10 years for guys like
you. Mental fortitude enables one to endure, which would be the appropriate response to it.
Ayahuasca.
Right?
Yeah.
No, but I mean, look, Brad, I've known Brad a long time, and there was, what do you think when you look back? You started your fund, in 18, 17?
Yeah, 18.
And then, you were at Ivory before that, doing the same thing. When you look back over the last 15, 20 years, what do you look back at as like when you realized things had changed and there was this persistence and there wasn't the steady arbitrage based on valuation that the three of us all grew up with, of like, oh, there's enough eyeballs on it and market makers saying, hey, this is where the stock should trade, to where now we're in this new regime where the percentage of assets owned by passive and quant and factor, etc. What do you think that wake up moment or realization moment was for you in your, evolution as an asset manager?
All right, so I began my career in the long short equity business in 2004, and again, from a fundamental value oriented fund, you might find an investment that you thought was worth 15 and you'd build a position at 10. And it was attractive, let's say a double-digit free cash flow yield, and something would go wrong. So that $10 stock would go from 10 to 9 to 8. And I came from this lineage that reinforced, if you don't have conviction, you should never have been there in the first place, right? So when it dropped 20%,
double down.
You had to double up, right? And you had to scale into that position. And I say it to some extent in jest, because when that occurred, right, it would go, you double it up at 8 and it would go to 15 and you'd look like a hero. And if you think about that environment, call it the 2004, 2005 period of time, it was dictated by active managers that were picking up the phone, doing due diligence, speaking to companies, right? And those were the marginal, we'll call it price discovery players in the market. Fast forward to today, right, a couple decades, and that $10 stock goes to 8, and it garners a negative momentum factor. It gets booted out of an indices, right? Quant funds start to short it. The platforms are significantly shorted, right, albeit factor hedging. And it might go to 2 or 3 before its eventual resumption to 15. And the reason I'm giving you this...
If you're lucky.
So it brings in a real question, right? What environment would you rather have? And how do you position capital deployment and risk management for those respective environments. And to me, it's very clear. I'd much rather have the current environment today, but the caveat is you need to be able to see those investments through. The guy who buys at 10 and then it goes to 8 and he doubles up and it goes to 6 and he doubles up again is out of business. And Ben, you asked the question, when did it change? And I think in around, call it 2014, 2015, give or take a year, there were a lot of managers that had that same school of thought. Oh my gosh, it's now a 12% free cash flow yield. You've got to load up. And there was a misunderstanding that price mattered to the marginal buyer and seller. And today it does not. So what I found managing a portfolio in that period of time is there were no bounds anymore. And many of my peers, right, still employed that same historical mindset of increasing and increasing and increasing. And to me, it was in that period of time where I would see a complete dislocation from fundamentals, and then those equities would continue to dislocate, right, in the complete opposite direction I reaction, kind of woke me up and forced me to reevaluate who the price discovery players were in the marketplace. So hopefully that perhaps gives you some context on at least my period early in my career to where we are today. And by the way, if you went through COVID, that $10 stock going to 2, right, it occurred everywhere. So it goes back to, can you position a portfolio to see it through?
Yeah, I mean, I remember very distinctly that doing a lot of arbitrage and long side stuff between 2010 to 2015, and then unfortunately getting much more heavily short in the 2016 to 2021 period. Let me tell you something, that long only period was a lot happier period, as you know, as my friend. And it took a little while to learn that, right? And maybe it's like the boiling frog that doesn't realize, and then one day you wake up, you're like, wait, what's going on here? And, now it seems obvious, but like it was a process. And so, all right, what do you think when you think about opportunities then of the evolution of the market structure? Where do you see how your money management or idea identification or risk management has changed,
or capital base? I'm going to add that because that might be the more important one of all. Like, you have to have the money to stick with you in order to have the duration of that investment.
That's right. And I think that was the peril of a lot of hedge funds in that 2015 period of time, is their investors did not have the duration of capital to see these things through, right? And we live in a world where there's a score on the board every day and every year. And if investors don't like that scoreboard, right, there's different appetites for duration. But the interesting thing, and maybe I'll flip it back to the two of you, what would you rather have? Would you rather have an environment where a $10 stock can go to 2 and then to 20? Or would you rather have that 10 to 8 to 15 environment that you had in 2004 and 2005? I'd argue the former. But that's just me.
You just tell me what capital you have, then I'll tell you which one I want.
I agree with Nadine. I've come around to the view that all of finance is just liability structure. What's your liability structure? That's all that really matters. These VC guys, we all celebrate them. They have or private equity guys, they have unbelievable liability structures, right? Yeah. They're like, hey, we're gonna take big bets on flyers and using leverage and etc. And you can't call us in, as everyone just found out in the last couple of years, as everyone tries to redeem on their private equity guys. And then versus if it's Butler Hall Capital or us, they're like, hey, we're going to need our money next quarter. Thank you very much. We enjoyed being an LP. Good luck. You know what I mean? It's a totally different ability to hold assets and what you can hold and how you go about it, right?
Yeah, it is. It is. But ultimately, if you can find the right alignment with LPs, it's a great setup for alpha generation.
So you with individuals and family offices, or what do you have as your base?
We're mostly institutional from endowment, et cetera. We do have some multifamily offices as well.
So,
yeah, go ahead.
Just to the capital base thing also, I know we've talked about this, and Nadine, manages pension money, and so what is the current status of the Mag 7 and Fantastic 15, as I like to say, but like the top of the market, right? Well, look, we're all trained from the pre-GFC old school era. And in that era, the idea was you got to a certain size and then kind of the law of large numbers applied and scaling properties weren't there. And then capital wouldn't keep flowing to you, right? Whereas obviously that is all flipped. And so how do you view that? How difficult is that as a discretionary asset manager, having the very top of the market of the stocks everybody knows, the most liquid stocks, be what you got to own in order to keep up? Like, talk about that treadmill or that optimization problem, and also just from attracting capital as well.
No. Well, what was the Mag 7 gone from? I think it was just under 10% in 2014, and you probably know better than me. I think it was about 35%, or just
somewhere in there. It was in the low 30s, yeah.
As a mid-year. There is the history of these companies. I'll give them a compliment first. These are some of the better businesses we've seen in public equity markets historically. And in many respects, a lot of these businesses came out originally a decade ago, 20 years ago, with very high multiples, but had incredible business models, and they grew into those multiples. And in hindsight, were actually phenomenal value stocks, right? Now, as performance continues, right, that garners incremental asset flows. And today, this is at least my opinion, I think it is now a very significant risk management concern. Right. If I had an analyst that wanted to put 40% of the fund into effectively one factor bet, I would have some serious reservations, to say the least. And you think about it, go back to our comment earlier, the market today is no longer dictated by individuals or entities that care about price. You tell an ETF to sell, it will sell at 1 times cash flow, it will sell at 100 times cash flow. You tell it to buy, it will do the same thing. And that's what I think the market has become, where you have this Mag 7 representation of asset flows, right, and demand and supply. And then there's a whole host of other parts of the market that, I think are real companies with real investments that you can traffic in and generate a great return. So for us, we focus more in the $1 to $20 billion market cap type areas. And it's because we think we can get a tangible variant perception, a different view on the earnings stream relative to our peers, right? And ultimately, if we're doing our job correctly, can benefit from, right, the earnings growth component to that return, and then hopefully the multiple expansion.
So can I bug you on that? Can I get in there? So get in there. Get in there.
Get in the game. Let's go.
Get in the game. So one of the things that I learned, I used to do exactly what you did, Brad, is that, have you ever looked at, do you ever have satellites or buckets of names, or do you try to pick the one horse? There's this theme or whatever is going on, and this is the one company, and we're going to size that appropriately. Or are you hey, this data set, we had data centers, 14 years ago called data centers, and everybody thought that movement to the cloud was never going to happen. And so, we initially just picked one horse. And then I remember making the case to my team that we're idiots, that we could have picked the 4 best horses, and it would have been less volatile and even better returns, because our thesis was right. You didn't have to find just Equinix. You could have done Equinix and Interaction, all of these different ones, right? So do you pick the one horse, or are you picking buckets?
We're actually a little bit of both. Yeah. Right? If there's a specific misunderstood, we'll call it subcategory of the market,
okay,
that we identify, and that let's just presume we have a view.
Give me an example. What's one today that people don't get?
Okay, so I'll give you, earlier in the year, we had a large investment we built in Vistra Energy, which is a effectively natural gas and nuclear independent power producer. We built a position in that, but also found other parts of the market that we wanted to garner exposure to, with manufacturing of gas turbines, right? The liquid cooling. So we built smaller positions to express those views, but
Yeah.
ultimately we had one big horse that was driven by bottom up fundamental value, which was Vistra. So I do a little bit of the other way where it's, hey, I want to allocate this amount of capital into this part. We'll put that at work, and then we basically use our diligence to refine and scale up and make sure that we're effectively betting on the horse we want.
But so like that's a good question. So in February of this year, and Nadine knows in our Wall Street Beats chat, I started talking about the power thing, and I was like, maybe it's already late. Like I thought it was like very well known, or maybe it was just at the and obviously it was a big theme for the year. There's a point when you're like, hey, I'm buying a stock that nobody knows, or I have a huge edge, and it's asymmetric in the beginning. Unbelievable trade, and you want to get as big as you can in that moment. Then you get to the point where the market kind of knows, and you don't have that much of an edge, but there's a lot of returns in rolling with the market there. Like, how do you think about that? Of like, hey, I might not have much of an edge over the market anymore, but I know that I'm on the right horse and I'm going to ride.
If I were to criticize myself, we take profits. So I generally do not let it ride to the degree of others. And, that I think perhaps can be a hindrance to returns in large up cycles, but conversely protects capital in down cycles. Let me actually give you perhaps a little bit of characterization, because people turn on CNBC and they see data center this and data center that. But I want to give you some context of our process and history, because perhaps it ties a little bit to what Nadine mentioned. So we had a position in a spin, you'll know it, Constellation Energy, CEG. And we purchased it in the summer a couple years ago, immediately after the IRA bill was effectively put through. And the reasoning behind it was that as a pure nuclear plant, the IRA bill guaranteed a trough cash flow stream for nuclear producing assets. So if you dropped effectively below a certain level, $42 a megawatt hour, every dollar it dropped below, the government would effectively cut you a check. And that bill dramatically changed the earnings stream of this, we'll call it subcategory or asset class. So in a period where, interest rates were 3% or so on the 10-year, you were getting a guaranteed 8.5% free cash flow yield from the government as trough cash flow stream, and you got the entirety of the upside to the extent power prices moved. I'm giving this into context because that inserts process and change that necessitates why a valuation should be dramatically different versus prior periods. So we held that actually for a couple years. And in January, we sold the entire position, right? Perhaps you'd say, prematurely, but we sold it because we moved the entire position into VST or Vistra Energy. And the reasoning behind that at the time was demand all of a sudden was dramatically starting to change. And yes, everybody looks at the data center stuff today, but there's a lot more to it that changed an industry that was at best 50 basis points of industry growth a year to what now may be multiples of that for the coming decade to 15 years. And VST effectively was 5 times cash flow, right, at that point in time, buying back stock, great management team, but it also had upside that wasn't just nuclear. It was gas exposure because they had significant latent capacity. So the reason I'm giving you this context is as you understood how the industry was changing and as you recognized that the demand profile was far greater, right, it necessitated a capital allocation decision, which ultimately was right in hindsight. I think VST has outperformed CEG by probably about 100% year to date. But it comes down to that long-term process and following it to be able to actually make those decisions. And by the way, I'll just give you one tidbit because everybody likes talking about what's taken place in the last 6 to 12 months. People have seen the headlines of 3 Mile Island, right, which is being restarted now as a result of a data center deal. And the pricing on that, if you look in, is about $125 a megawatt hour. Price in the market today is $45 to $50. But the projected demand for data centers over the next 5 to 10 years is basically one of those deals every 6 weeks through the end of the decade. It's kind of a tidal wave of demand. And even despite the appreciation of some of these securities, they trade at below market multiples with pricing that's 40% of contracted levels from hyperscalers. Anyway, I gave you a very long-winded response, but perhaps might give you some context on that.
Right, but I would just, I work with some guys. Actually, Tom was on our podcast a while ago talking about power, and he said he's short that forecast. He said that he's short that, and he thinks that a lot of these banks guys are just kind of linear thinkers, and they don't understand that engineers make things more efficient, and there's a bunch of constraints, etc. So there's a lot of issues with that, but I guess it doesn't really matter, right? Because my point isn't about that. I don't want to argue about that. It's like when we think about equities, and you guys both know I like macro and I like special situations because I can get my hands around it. It's more mechanical. Equities has this like terminal value narrative component to it, right? Like, what's the story we tell each other? Like the cash flows for next year, whatever. But really, it's like, what's the cash flows for the future? And we all have to have this agreement on the story. Is the story getting better or is the story getting worse? I mean, how much do you think about the narrative and the sentiment? And do you think about it? Because some people don't even incorporate it. It just comes into them. Like, do you ever think about like the impact of bias and feedback mechanisms and the news has on you and how that impacts your portfolio management and your decisions on securities? Because some people buy high, sell low, and they were right on their fundamental view, but there's things that get in the way of the story, right?
So of course you need to think about that. It also depends on what you're paying for that, right? If you're paying 5 times cash flow and the market is assuming a pricing level, right, in the industry that is in line with history and is frankly right well below the expected probabilities, you probably don't need to think too much about it. If you're paying a premium, right, to the overall market, there's a very different, right, risk reward assessment. So we kind of come back to the reassessment of our names of, is this a better than average company? What is the future return on capital profile of the business? What is priced into the stock, not just from a fundamental perspective, but also an expectation perspective? But I will make one caveat, and this goes back to my roots. We have businesses in the portfolio where I underwrite that no one will buy it into perpetuity. And what I mean by that is, if you go deep into the fundamental value part of the market, particularly in kind of the, call it $1 to $5 billion arena, there are stocks that trade at 3 to 4 times cash flow. They pay it all back in the form of a dividend or share repurchase. And if you own it with a long enough duration, right, you don't need to require or anticipate anyone else buy the stock. And I think that's one of the bigger changes, perhaps, at least the way I've assessed things in the last 10 years, is it was good enough to have a low multiple business that perhaps was a discount to intrinsic value 10 years ago. But today you need to see that consistent return on capital to really justify the IRR to continue to deploy it. And in that part of the market, I don't care what people think about the stock. If I'm getting 3 to 5 times cash flow and it's coming back to me every year, I've got my IRR right there, right? And hey, there's an option that things may change in terms of perception down the road. That's where you really get the big IRRs, where you've got that well below average multiple, and then you get that intersection, right, of a change in perception.
100%. Those are my favorite longs by far. Like you get the low duration, short duration asset, then you have an embedded call option. And that's the exact way to think about it from a structural standpoint. Like, hey, it could be private, doesn't matter. And then I have that valuation narrative, whatever, like component to it. And like, it's just a better risk adjusted thing over time. Not as fun though when MicroStrategy is just going up every day. That's more exciting, isn't it, Brad? Unless you're short.
And how much is the work that you're doing U.S. versus international?
We're about 75% U.S. And then with respect to international, it's developed markets. I neglected to mention I come from an accounting background. I had a Master of Accounting at SC as a postgraduate degree, and I came into the market in the post-Enron era. So we put a big premium on GAAP accounting, IFRS, interaction with management teams. So generally speaking, it's developed markets.
Okay. So I'm pushing the buttons today. So pushing it, pushing it.
The easy
So
button. Is it the easy button, like the
lots of
Staples
buttons,
easy
lots of
button?
buttons. So, I buy that a long time ago. And maybe I buy it now because what you're saying is a lot of people don't do it anymore, right? But some tools have made what you do and just getting some basic work done so much easier. Like if you had S&P Cap IQ 15 years ago, that would have been helpful, right? Because they have some data, at least it's spread out, you can download it, like it just saves some time, right? And certainly it doesn't have all the data and it's not going to have the management calls that you want to do in there. But and maybe what you're saying too is just like, hey, there's fewer people doing those management calls and the management meetings, but the management teams are out there more, they're communicating more than they were before, right? They have a lot more outlets on the internet and the like to be chit-chatting about whatever they're doing, so information flows faster, not just from their mouth but amongst other people's mouth. So I'm trying to get a sense of like, why is it that what you're doing has the edge today? Like, where is it? Is it because the fundamental value people like left town and then are replaced by the quants and the machines, or what is it? Because I used to play that game and I know that the tools and the availability of data is so much greater. So I'm really trying to like dig deep here. Is it just because you're like doing like the Bain type, private equity type analysis that we did 15, 20 years ago, and that's coming back in style and other people don't have the time to do it, or maybe their durations are different, so they need to make money in days, weeks, and or month, and you have the ability to make money in 2 years. Help me try to understand, like, if you could kind of prioritize for me, what is it that gives you the edge?
So let me ask you this. Have you attended a large, right, we'll say industry conference in the last, whatever, whether it's a year or 2 years, 3 years, right? Whether it's the JP Morgan Healthcare and SF, right? Because I know that's close to you in January, or, the reason I ask is
it's not like the heyday when Sting and Lenny Kravitz were playing, right? And everybody was there, right?
When I started, you'd go to a meeting and the guy seated next to you was Leon Cooper. Right.
Like everybody was there.
The management team. Why aren't you buying back stock? Why isn't your guidance right, et cetera? You go in today, there's like 8 guys in a room. They all look like they're 20 years old. They probably are. They have their computers up.
They're all probably wearing vests too.
They all probably are wearing vests. They have their computer up. They're not looking at the company, and they're just like autonomically taking information. And what are the questions they're asking, right? Is, oh, how are trends going in the month of November, right? What do you think is happening here? And I think the reason they're doing it is because we've seen the rise of these platforms, right? And they're focused on getting a tangible, we'll call it minute edge, right? That might add a point or two to performance, right? In a coming quarter or a coming couple quarters, right? We're looking for the 50, 100% returns the next couple of years. So rewind, right? COVID was one of the craziest environments I think we've all experienced in our careers, but we had KPIs that went one direction temporarily, but they weren't necessarily indicative of core fundamental KPIs businesses. So like we had a short, this was 2021, 2022, and I'll mention it because I'm assuming you know it, but it was in HelloFresh, right? And when everyone was stuck at home, there was this desire, obviously,
to learn to cook, right?
So all of a sudden, margins went from, I think it was 1.5% EBITDA margins to 10 to 15% a quarter in that kind of back half 21, early 22. So if you were in one of those meetings at a large conference, people would be asking about these KPIs of, what is the signups? What are the trends? How are you thinking about the upsell, the improvement of frequency, right? Are people going from 1 a week to 1.2 a week, right? The reality is that was completely irrelevant. Why? Because it was not indicative of the long-term sustainable demands of the business over the market cycle and beyond, right? And this company was benefiting, right, obviously, from accelerated demand, but also a collapse in marketing stream, right, to acquire customers. You didn't have to spend money in a period where people were stuck at home. The reason I'm giving you this example is here is an environment where this stock went up multiple fold because people were focused on the next quarter. And yet it was painfully obvious that this return profile long-term was nowhere near what expectations were. So to me, it's a combination of how, and it goes back to active and passive management and the type of investors out there. you don't have people like me doing the work of saying, hey, what is this worth? What is normalized earnings? How do we think about the next couple of years? Why is the churn here dramatically different, right? They're just typing at a screen and asking a bunch of follow-up questions that are largely irrelevant.
Well, so that's actually interesting because we talked about the passive role, but the truth is as we're all fundamentally trained people. Is post GFC, if you're trying to get a hedge fund job, it was very difficult to
Yeah.
get on with a 500 million, 1 billion, 2 billion like normal hedge fund like used to be a lot of them. We just had the rise of these, I guess they call them pod shops, multi-manager models. And then it goes back to what I said about liability structures. So these are guys who have normal LP structures, but then they have a bunch of leverage and they sell volatility. And so I think all the fundamental talent, not all, but a lot of the fundamental talent went there because they pay a lot. But I've talked to some of those guys. They don't have the ability to look out 12 months. They don't have the ability to hold positions for 15 months that they probably believe in, but they can't hold the position because of the leverage and the structure that they're in. And then also what our buddy Dave Dredge talks about in Sharp World. Everybody's stupidly compensated on a 1-year basis, not the long-term capital like gains or capital return over years. So I guess what you're telling me is that you're focused on your 3 or 5-year return and what what things are going to be in the future, not just the slight better fundamentals or less fundamentals and like the delta in fundamental change, I guess.
So
right?
to clarify, we underwrite that 3 to 5 year time horizon. And don't get me wrong, it's nice to have a definitive view, perhaps, that is variant to expectations in a given quarter, but that is, we'll call it an additional tool in analyzing, right, an investment decision as opposed to the primary decision, right? So you're right, a lot of these platforms, it's a very different model. They're trying to figure out how to eke out a very small return and lever it, right, in an idiosyncratic way. And again, phenomenal business model, right? They're not correlated to the indices. They've been highly successful, but it gives you a sense that if you look out a little bit further, the outfield's wide open, right? And that to me is where the real opportunity is, right? Provided you can structure it and see those investments through.
And I would argue that it's a massively crowded trade. Too much assets went there. Every pension's like, hey, I want 1% per month. And that's what they're getting for these guys. And that's why you see, like, I have a list of short stocks, and there's the short cover day. It's like these guys are degrossing, and they all do it at the same time. And honestly, it's now to the point where fading those guys is probably a profitable strategy. It's like when they degross, let's take the other side of them. You know what I mean?
It is logical to conclude, right, as these firms have grown in size, their liquidity parameters have also changed dramatically, right? And perhaps it goes back to your comments on Mag 7, right? If you want to deploy capital, you need to do so in the most liquid parts of the market. So the big players at XYZ platform, they don't care about the company that trades, I used to say 10 or 20 million a day. They probably don't care about the company that trades 50 million a day, right? But that's ripe for a fund that runs hundreds of millions of capital or even $1 billion fund, right? Can traffic in those and generate great returns. The other thing to probably think about is that we have big allocators, think of pensions, endowments, and they've allocated material components of their investments to basically alts, right? Private equity, right? Illiquid investments. And in the last 5 years, I don't know about you, I haven't gotten that many monetizations from my alts. We've had this just sucking up of capital. Well, if you're a big institution and you have potentially capital calls and you're not receiving inflows, where are you putting your public equities? You're putting them in the most liquid, biggest parts of the market. And it would not surprise me that that's had actually an influence or impact on perhaps, mark-to-market valuations in the current space.
Yeah.
Think about it, right? If you're in a illiquid set of companies and you have no spare cash or limited cash and you get a capital call, right, you need to be ready for it. And if anybody who's experienced what Q3 and Q4 of 2008 went through, right, liquidity has material impacts on security prices. If you're a big allocator of capital, makes sense to me. Park it in the most liquid part of the market.
Yeah,
And
they're called T-bills, and you've
Yeah.
been getting
yeah,
5%.
yeah. And is that justifying some of the hurdles they have? Maybe, maybe not.
I don't know. I don't. I'm not really. No, I'm talking about the pensions. You're saying that. Okay, I understand. The pensions versus the manager. Right. All right. So then basically we're in a situation where we have now a world where multi-managers were minority players. I remember in grad school writing a quantitative trading strategy and learning about factors well before it was like a thing. And now that's the dominant thing. What do you think's next? What's the next evolution of the market as we look out over the rest of the 20s? We're at the hump year now, almost at 2025 in a couple weeks. What's your outlook for the back half of this decade? And will the market change? What do you think?
Well, I wish I had a perfect crystal ball. To me, I think we've hit a point of overcrowdedness where you see euphoria in a subset of securities that fuels upon itself. And I am terrified and also actually quite excited that if the currents change slightly, right, there's an enormous opportunity for investors in other parts of the market. Right? I think it was 12 months ago, I think Apple as a market cap exceeded that of the Russell 2000 for the first time. And you fast forward to today, there's a handful of companies that now exceed that. My point is, I think we're at a point where things can change quite a little bit, and you have these parabolic return profiles in perhaps the less trafficked part of the market. So for me,
but I have a question for you then, Brad.
yeah,
But that assumes, I think what you're saying is that liquidity comes from those that are crowded positions into the less crowded. But what if it's going down, it just goes out,
what do you mean
right?
goes down?
Like you can sell one stock and buy another. You could sell a stock and put it in cash.
Yeah, you could. But sell a
So
stock and put it in cash, right, has huge impact. Look, you see it, look at it month to date, right? What we're seeing is a flattish market, and then the average stock in the market is down materially.
right.
While 7 stocks in aggregate, right, are up materially. That to me is more a function of a reallocation as opposed to dramatic changes in flows. But if you think about that concept that I made, the comment I made earlier, it reinforces that $10 stock can go anywhere, right?
Yeah.
So at least for the strategy.
But then are you holding cash to take advantage of that? Or are you in positions hoping that the cash is going to come your way?
We are running, I'd say, a relatively lower levered portfolio, right? So we run about 100 by 55, if you think about long versus short. And that creates effectively cash capacity to act from a position of strength when things dislocate. So go back to January of 2021, right?
Yeah.
The Melvin Capitals, right? GameStop,
Sure.
AMC, et cetera. Our best month in history was actually in February of 21 because we were able to act from a position of strength as a result of our diversification, I'd say conservative allocation process. So in periods where our peers were exhibiting forced liquidations, we were the ones to take advantage of it. And it paid off quite well.
So, but I guess this is another interesting question. So my kind of view on asset prices is it's just a duration decision by savers, right? You oscillate between a zero duration or as close as you can being cash. Most people can't get totally to cash, or all the way out, which I would argue we're pretty close to max duration right now. And you can see, like Bank of America put out a chart today, the flow of funds data, foreigners' percent of allocation to equities as a percent of total, we're all at max. So where is the bid going to come from for the aggregate market? And how do you manage a portfolio if we're in a sideways to down market for, let's say, multiple years?
Well, I don't try to prognosticate broad markets, except I would guess a flat to down market would be one of the better setups for our strategy. Euphoria, we are conservative. We focus on preservation of capital. We focus on downside protection. that generally does very well in periods of greater volatility and perhaps, right, less euphoria, right? I come from a contrarian mindset, and as a result, right, in down markets, we generally not only outperform, we're often up. So the notion that some bubble stock can drop in a flat or down market, that's great for us, right? We have the ability to generate alpha on both the long and short side of the portfolio, which is ultimately what our job is.
Okay, so then basically we're in a situation now where if you had a flat market, that's good for active management. Do you think I like the joke, because now we're in the Trump era, make active management great again, mega, and do you think we could be like post 1999, 2000, 2001, which was very similar to what's going on right now? We could have a golden era for hedge funds again, or is that just me as an old guy kind
Hoping.
of dreaming, hoping and dreaming, I guess?
I'm cautiously optimistic. There are a fair amount of similarities. The caveat is the biggest performers in the market are phenomenal companies, and they currently don't trade at the valuations of some of the what we saw in '99. Now, there was a upgrade today. We might as well. I might as well bring it up in jest, but there was an upgrade today of Tesla, and the individual or the firm that upgraded it put almost $1 trillion of value tied to businesses that are not commercial today, right? I.e. the bot, right, and autonomous driving. And that is probably the most notable 99-esque note I've seen in my career, where, right, this isn't a couple billion of prospective value. This is, $1 trillion on something that's yet to be developed. And again, no opinion on that specific company, but you often don't see analysts upgrade stocks, take price targets up by near 100% on something that doesn't generate $1 of revenue. So perhaps we're getting there. But
did you know that we shorted that today?
I did not.
Back in the short Tesla business, baby.
But you see a note like that, and you're like, how can you logically do that? And again, maybe it's a great call, right? Time will tell.
But can we come back to you though on obviously no one's got 100% hit ratio unless they're lying. Like, how do you know when you're wrong and you need to get out? Like, what are the signs that what do you do? And what are the typical scenarios usually?
Yeah, generally the ones we've made mistakes have been poor corporate governance, where you actually have real value in a business and a manager begins to act perhaps in what I would say is not the most advantageous to investors. That to me has been an area where we have had problems in the past, and we've had to cut and move on. Other aspects would be areas where perhaps we misunderstand, perhaps the tailwinds or lack thereof in an industry, right? We think an industry is growing at a few percent a year, and dynamics change, and perhaps it starts to stagnate or decline, right? We reassess and move on. Generally speaking, what I've found is we rarely lose money on the longs we put to work if we're wrong. We generally get off at a with a small profit or something close to where our price was initiated. The caveat is, right, that's a drain on capital, if you will, on IRR.
Yeah, sure.
But one of the benefits of public equities, and we don't seem to realize it or emphasize it enough, is private equity has perfect information. Public equities, we have liquidity. So if your investment thesis changes, you need to move on, close it out, right, and move on to the next name, because you're right, it's a batting average over time, rather than a slugging ratio.
Well, you can lose more than you win if you just win big when you win.
Yeah, sure. Yeah, VC model, of course. When we look at our firm's returns, even this year, our biggest winner is perhaps 15% of our total P&L. So we're more of a singles and doubles type of investment firm. But I came from this mindset of never blow up, preserve capital, right? That's kind of the most important currency. And, that's the strategy we employ.
And looking ahead, what are some of the more interesting areas that you think that people don't understand?
Yeah. So I alluded to it earlier. The older economy, industrial landscape, I think is ripe with interest and opportunity. And that's actually, by the way, not just on the long side, but the short side as well, because there are companies that are dramatically over earning as a result of some of the huge capex investments
Sure.
onshore. We think you asked earlier about geographical allocations. There is enormous discounts in international markets compared to US markets in certain companies that perhaps are identical, right, to that of their US counterparts. So we've found a lot of value in European or Asian entities with US businesses that effectively see catalysts perhaps to relist, right, or rectify that dislocation onshore. And that's actually kind of shocking. And we found it with one of our core investments earlier this year, where it was acquired because the parent, in my opinion, was seeking to relist in the U.S. But that, to me, cross-border allocations are very interesting at this juncture. The other thing is, and it will shock you, but capital structures today are less understood than 2008, than 2005, and 2002. And we found businesses that trade at 5 times cash flow, but in actuality are debt free at the parent because of the way the capital structure is set up, and yet poor sell side coverage or lack of training on behalf of the sell side can't rectify or understand that. And that, to me, is a huge advantage for a fundamental investor.
Mm-hmm.
Okay, well, so basically we're now sitting here and you're just telling us is that, hey, I'm an old school guy, I'm disciplined, and I think that the market's gotten more inefficient because of the factors we've discussed: liability structures, the passive management, the quants, the non-thinking participants, the lack of arbitrage, etc. And you think that business model is going to grow, or you just think it's going to maintain? And what do you think about the hedge fund business in general on a go-forward basis? Because obviously we are a breed that is out of favor, if you will. Might call us coal workers.
I don't think the business is permanently impaired. Obviously, there are improvements that the industry needed to adapt to with respect to transparency, right? The offering of SMAs, et cetera. So putting that aside, I think ultimately we haven't seen a sustainable down cycle where long short equity can truly show its stripes. And we caught a whiff of it in 22. And as the tide came out, I think you saw that some investment firms that stated that they were hedged were not. But we haven't really seen that continuation of it. In my opinion, there was a comment in a different podcast of an investment professional that I respect that made the statement that it was the most inefficient market in the individual's career today. That is the case now. So the question is no longer finding a great investment. It's identifying when that investment pays off. And that's why, at least in the value bucket of our allocations in the portfolio, we tend to allocate more to businesses that allocate significant cash return, right, in the form of dividends, buybacks, et cetera. But I don't think the hedge fund business is dead. I just think people have gotten a bit lazy in the fact that they continue to own what is working, and you can't blame them.
Especially after they made a mint on Bitcoin, right?
Right. So Bitcoin goes up 50% in a month, right? Everything crypto related goes up. There's a little bit of a similarity to the mania we saw in 2021, right? But ultimately, these businesses need to stand on their own. They need to generate cash flow. They need to actually justify those investments. And those buying the stock are there as renters. They're not investors. So if you're allocating in a different part of the market, where you can not only invest in businesses that generate great cash flow, but perhaps there's a thesis where it might be desired, right? And there might be a great growth story underneath it. That's where you really get paid, right? If you boil it down, find the value stock with a growth trajectory that is not understood, and that's a setup for a parabolic return.
Well, thank you so much. I mean, obviously, a lot of people are going to learn not just what you're doing, but hear a different take on the opportunity set today and what you're expecting probably out of 2025. So I know we could spend a ton of time with you, Brad, going through that. Because a lot of people, you make money and you think you're smart until but then you find out maybe you were lucky, right? Or smart for a short period of time. But you've been a horse in this race for a long time here, so people need to listen up. If people want to find you and learn what you're doing and get in touch, how do they do that?
They can shoot us an email at blundy@butlerhallcapital.com or ir@butlerhallcapital.com.
And because Ben's going to love this, do you have a LinkedIn?
I do have a LinkedIn.
There you go. Well, thank you so much. We really appreciate you joining us, and hopefully we can check back in to see what you're doing in 2025, what money you've made and where the new setups are. So thank you so much, Brad.
Sounds good. Pleasure. Thank you.
Thanks, buddy.